Hello, my name is Patrick Farron and I'm Chief Investment Officer and Lead Portfolio Manager at Wealth Management International in Peoria, Arizona. Welcome to our third quarter investment update and outlook. Today I'm going to start out with a description of how we see the current economic environment that's impacting investments in the stock market, the bond market, and alternative assets as well. The most important thing that we're seeing right now is that the U.S. economy is continuing to grow moderately and with low inflation. Most of the growth in output now is what we would call self-sustaining. It's based on the internal momentum of the economy, and a lot of that is coming from increased consumer spending. The consumer spending has been supported by continued good job creation. As new jobs are created, unemployment has fallen to quite low levels, and also average wages are increasing, not particularly fast, but well enough to help support increased spending. Consumers seem pretty optimistic, and they're spending a lot more than they did just a few years ago. Just as important nowadays, though, is that we're starting to see some glimmers of hope for other major sectors of the economy. For example, the housing market looks healthy with new home sales and existing home sales rising, increased construction of single-family homes. We're seeing some evidence of improved corporate investment, and we're seeing some signs that the U.S. economy has adjusted to the strong dollar and that exports are starting to improve. As I mentioned a bit earlier, one of the other positive factors in the economic situation is that inflation pressures are still limited, even though we're seeing continued growth. Part of that is just from the fact that even though demand is increasing, it's increasing at a relatively slow pace, whether that's because of demographics with more and more people retiring, or people being skittish about going into debt because of the financial crisis a few years ago. In any case, demand pull inflation seems to be pretty weak. At the same time, there don't seem to be unusually strong cost pressures for businesses. As I mentioned before, wages are increasing relatively modestly. There's a lot of excess capacity in the industrial sector. A lot of firms have relatively high levels of inventories, and with the strong dollar, import prices are also held in check. Turning to the foreign arena, there's also some good indicators from a lot of the major developed countries around the world. In particular, we like the trends that we're seeing in the Eurozone and in Canada. Turning to the actual data and some graphics, first of all, we like to show how the U.S. Economy is doing in terms of gross domestic product. In other words, the total value of all goods and services produced in the economy in a particular period. This chart shows GDP growth on an annualized basis over the last several quarters, and even though the growth rate in the first quarter was a bit weak, if you look at the longer term over the last several years, we're actually growing just about at the average rate over the last 20 years. In fact, slightly above that rate. So again, it doesn't feel particularly good to a lot of people because a lot of people focus on those strong growth rates we saw back in the decades right after World War II. But in reality, right now we're growing just about as we have over the last 20 years. Again, I mentioned that a lot of the growth, the majority of the growth is coming from the consumer sector. In this chart, I'm showing, first of all, disposable income. With the red line, that's representing the annual growth, the growth in 1 month versus the same month 12 months ago. And you see that disposable income is growing at a decent pace, but even more important, the chart is showing personal consumption expenditures. And as you can see, over the last 9 months, the annualized rate of personal consumption expenditures has been even stronger than the growth in disposable income. Of course, that means that the savings rate is going down, but it certainly has been enough to help boost the economy. And so why is the consumer sector doing so well? Well, a lot of it is because businesses are creating lots of new jobs and soaking up those workers who previously were unemployed. The U.S. unemployment rate now is quite low and right in the range where we were in the years before the last financial crisis. And again, coming back to the issue of wage growth, this chart shows the annual increase in average wages with the blue line, and you see there's a very modest acceleration going on, but just as important, the chart shows with the red line the annual growth in the consumer price index. And what the chart really is showing is that over the last couple of years, wages, even though they aren't growing particularly fast, they've certainly been rising faster than inflation, and that's giving consumers the wherewithal to increase their spending. As I mentioned, the economic growth seems to be broadening now. This chart shows the annual rate of new home sales, which has actually been climbing for several years at a pretty steady pace, but I think that a lot of people really haven't felt the positive impact until fairly recently. A lot of businesses also, I think, are in that boat. Of course, home sales aren't nearly as strong as they were before the housing bust, but that probably is a good thing. Also, we're seeing some evidence that corporate investment is improving, and one indicator that we look at to get at that question is the level of non-defense capital goods orders excluding aircraft, which we consider to be a pretty decent proxy for investment spending. And even though the year-over-year performance of that sector of durable goods orders was relatively weak, you'll see that over the last several months we've apparently turned the corner, and now those orders seem to be growing. Finally, I mentioned the export sector. Even though the dollar is still pretty strong, it looks like businesses have adjusted to it fairly well, and in recent months the year-over-year increase in exports has been not only positive but fairly solid. Finally, wrapping up our discussion of the economy, I want to focus on the consumer price index, both the overall index and the core index, which excludes the very volatile energy and food components. I think the story here is that either way you look at it, inflation is modest. Right now, both the overall CPI and the core CPI are up less than 2% from a year earlier. That's a little bit lower than the 20-year average, and just as important, it's consistent with what the Federal Reserve would say would be pretty modest inflation. So now turning to the financial markets and focusing on how things have gone over the last quarter, the second quarter of 2017, in very broad strokes, what we're seeing is that U.S. stocks continue to keep rising, although maybe not quite as strongly as they did in those first months after the presidential election last November. Just as important, foreign stocks have finally started to rebound after a period of pretty weak growth, and now I think you would have to consider the performance of foreign stocks quite strong. Bonds, in contrast, have been fairly tepid. Of course, right after the election, there was a big drop-off in bonds as people were worried about much stronger growth and higher deficits and things like that. More recently, the bond market has been stabilized and is starting to recover a bit, but the total returns are still pretty weak compared with equities. Finally, in the alternative sector, things are a pretty mixed bag, with real estate and precious metals doing okay, but several other alternative assets falling. Looking at those assets in greater detail, U.S. stocks remain in the bull market that they've been in ever since March 2009, so it's a pretty long-running uptrend. The recent total returns have been led by large cap stocks, with smaller stocks lagging pretty significantly. The strongest sector has been technology, along with healthcare, industrials, and financials. Now, in terms of the fundamentals for stocks, it certainly is true that valuations after this long bull market have gotten sort of extended. The way that we calculate the price to earnings ratio, the ratio looks to be slightly above 30, whereas the long-term average is about 26. Nevertheless, some of the other indicators that we pay a lot of attention to look much more benign. Earnings per share have not reached the extreme levels that we've seen in the past right before a downturn. The yield curve doesn't look too terribly steep. Transportation stocks have started leading the broader market again, and over 70% of the stocks in the S&P 500 are now trading above their 200-day moving average, which we consider to be a sign of good breadth in the market. Just one graphic here showing the S&P 500, in other words the U.S. stocks versus the valuation. And again, the green line shows the price earnings ratio as we calculate it. And it certainly is higher than it had gotten right before the financial crisis in 2007, 2008, but it's not nearly as high as it was back in the tech boom in the late 1990s. Just as important is the fact that with the good economic environment that we talked about earlier, the rate of earnings for companies in the S&P 500 has been improving recently. We've seen earnings per share up 10-20% in recent quarters. They do look like they're going to moderate in the coming quarters, but still we see the earnings per share growth as enough to help support stocks going forward. In the foreign sector, as I mentioned, foreign stocks are doing quite well recently. In fact, the first 2 quarters of 2017 have seen the strongest performance in foreign stocks since late 2010. That seems to come mostly from an unexpected improvement in foreign economic growth and less concern about financial risks, especially in Europe. Some of the markets that we find especially attractive remain to be Canada, Switzerland, Hong Kong, Taiwan, and India. Even though the foreign stocks have been doing quite well since the end of 2016, it's important to keep our perspective. It's important to remember that really over the last decade or so, foreign stocks have really gone pretty much sideways. It remains to be seen whether foreign stocks going forward will finally start to show sustained good growth or not. Turning to the bond market, as I mentioned before, we are seeing some recovery now from the post-election sell-off, but there are primarily policy-related headwinds. It doesn't look like people are so concerned like they were after the election about much faster economic growth and big deficits that would cause an oversupply of bonds. Now it seems that the focus is much more on the possibility of the Federal Reserve and other central banks tightening monetary policy, perhaps too rapidly. The Federal Reserve is still hiking U.S. interest rates, and within the next couple of months, it looks like they'll start to cut back on their asset holdings. Just as important, recently there have been indications that the Bank of Canada wants to tighten, and indeed this week they increased their interest rates for the first time since I believe it was 2007. And then finally, the European Central Bank is hinting that they're getting ready to cut back on their bond purchases. Those foreign moves are important because with ultra low interest rates and lots of money being pumped into the foreign economies, a lot of that money has flowed into the US and driven up bond prices. So it is something that we're watching closely. However, because inflation all over the world still looks pretty tame, we suspect that most likely the foreign central banks and the Federal Reserve will keep tightening policy at a slow, gradual pace rather than something that's going to be too disruptive. Besides that, we still believe that the hunger for yield, especially among pension funds and other big institutions, is going to keep up the demand for bonds fairly well. Turning to a graphic on the bond market, one thing that we look at is whether the inflation rate is giving us any indication that bonds might be challenged. In this chart, the red line shows the change in inflation, and what you see is that when inflation gets to a particularly low level and then starts to come up, that often is a time when bonds will pretty much go sideways on a total return basis. And indeed, looks like we're coming off of a period like that. So again, bonds, even though they're recovering and starting to move up a little bit from the post-election sell-off, this chart is a reminder that we probably aren't going to see big returns in the near term from bonds. Finally, turning to the broad category of alternative assets, there's lots of different subcategories here, but of course one that we find to be historically attractive is publicly traded real estate investment trusts, or REITs. The REIT sector, we think, is facing some really conflicting trends right now. On the one hand, moderate economic growth would be expected to increase the demand for real estate, whether we're talking about retail properties or healthcare properties, office buildings, apartments, cell phone towers, or whatever. But at the same time, the fact that interest rates are going up typically is a challenge for REITs, even if rates are going up fairly slowly and gradually. Turning to the other major alternative group that we look at, the commodities, again, it's very much a mixed picture in the sector right now. On the one hand, energy prices, which we had gotten a little bit more optimistic on late last year, they're starting to look like they're probably not going to be able to rise too terribly fast in the coming months and quarters, primarily because U.S. oil production is again starting to rise pretty rapidly and potentially offsetting the big cuts that the OPEC and its partners agreed to late last year. On the other hand, agriculture seems to be looking good. We've finally seen some bad weather, which has produced drought conditions and held down yields for wheat, corn, and soybeans in the U.S., and that seems to be helping prices for those commodities. At the same time, the modest improvement in global economic growth seems to be helping industrial metals, but on the other hand, precious metals are under pressure because of the potential for a rise in interest rates. Just to give a graphic on that increase in crude oil production in the U.S., I focus a lot on this because the energy sector typically is a big part of the commodity area and usually a pretty big part of the exposure in the broad commodity funds, and as this chart shows, we're almost back up to those record highs that we saw several years ago, and that probably is going to hold down the potential for oil prices going forward. Finally, just a quick word about what we think the future holds and what our strategy is in response. In terms of the outlook, we think that the current economic growth at a moderate rate and the improvement in corporate profits is likely to continue in the near term. As I mentioned before, we believe that the U.S. economy is in a virtuous cycle where it's basically growing on its own momentum, and as the growth continues, it seems to be pulling in more and more sectors. We do see some upside potential. President Trump's pro-growth economic agenda, with the prospect of deregulation and potentially some higher spending on infrastructure and initiatives like that, would be a positive if it gets passed through Congress. And also stronger demand overseas is likely to help out as well. However, there are some downside risks. The strong dollar, if it goes higher again, would be a concern to us. If the world's central banks make a mistake and actually increase their interest rates too rapidly, that would be a problem. And then finally, one thing that we're keeping an eye on is that the U.S. auto market seems to be softening after several years of really strong growth. We don't expect that profit growth would continue to grow quite as strongly as it has very recently, but we do expect profits to keep growing. In addition, the strong growth that a lot of companies are seeing is helping to improve corporate financials, and just as important, household balance sheets seem to be in good shape. Even though consumers are taking on more debt these days, it seems to be pretty much in line with their growth in income, and so their balance sheets look to be in good shape. What this all means for our strategy and our various portfolios, no major changes at present. We still are basically keeping our allocations to stocks, bonds, and alternatives right at our long-run targets. In other words, we're keeping them even weighted. Within stocks, we are emphasizing large and medium-sized companies over the small companies that have been lagging. In addition, we're overweighting financials in large part because they are likely to be helped by modestly higher interest rates. We like industrials because of the improvement in corporate investment and the potential for more government investment in infrastructure, and we like consumer discretionary because of the ongoing growth in consumer demand. In bonds, we are also taking advantage of the improved corporate balance sheets by modestly tilting toward corporate fixed income. Corporate fixed income also gives a little bit higher return, and historically has performed a little bit better when interest rates are rising. Finally, in alternatives, I guess the biggest change that we've made recently is that we've added the infrastructure subgroup as a way to what I call diversify our diversifiers, and hopefully add a little bit more stability and at the same time good returns in our overall strategy. That wraps up our presentation for today. We hope it was informative and useful, and we look forward to seeing you at our next update in a few months.